Hi guys, welcome to my channel. Before we get started, make sure to hit that like button. Also subscribe to my channel. Day trading is a viable investment strategy, so make sure to watch the full video. Introduction. Day trading has garnered significant attention in recent years, with individuals seeking to generate quick profits from the stock market's volatility. The allure of making substantial gains within a single day appeals to many. But is day trading a viable investment strategy? In this blog, we will explore the concept of day trading, delve into its advantages and disadvantages, discuss the essential skills and tools required, and conclude with an evaluation of its overall viability as an investment strategy. Is day trading good for beginners? Most day traders will end up losing money, at least according to the data. But with experience, your chances of succeeding can grow. Beginning traders should trade accounts with paper money or fake trades before they invest their own capital in order to learn the ropes, test out strategies, and employ the tips above. What is day trading? Day trading refers to the practice of buying and selling financial instruments, such as stocks, currencies, or commodities, within the same trading day. Unlike long-term investors who hold positions for weeks, months, or years, day traders aim to capitalize on short-term price fluctuations. Their goal is to exploit market inefficiencies and profit from intraday price movements. Day traders utilize technical analysis, chart patterns, and indicators to identify entry and exit points for their trades. Advantages of day trading. Potential for quick profits. Day trading allows for the possibility of generating significant returns within a short period. Successful traders can exploit intraday price swings to their advantage. High liquidity. The stock market, particularly large-cap stocks, typically offers high liquidity, enabling day traders to enter and exit positions swiftly without significant price impact. Flexibility and independence. Day trading provides individuals with the opportunity to work from anywhere and be their boss. It offers a flexible lifestyle and the ability to set their trading hours. Disadvantages of day trading. Psychological pressure. Day trading can be mentally demanding, as traders need to make quick decisions in a high-pressure environment. Emotionally handling losses and controlling impulsive actions are crucial aspects of day trading. Financial risks. The potential for quick profits is accompanied by substantial risks. Day traders face the risk of significant losses, especially if they lack proper risk management strategies or fail to implement stop-loss orders. Time commitment and stress. Day trading requires constant monitoring of the markets and staying up to date with news and events that can impact prices. The stress and time commitment involved may not be suitable for everyone. 10. Knowledge is power. In addition to knowledge of day trading procedures, day traders need to keep up with the latest stock market news and events that affect stocks. This can include the Federal Reserve System's interest rate plans, leading indicator announcements, and other economic, business, and financial news. So, do your homework. Make a wish list of stocks you'd like to trade. Keep yourself informed about the selected companies, their stocks, and general markets. Scan business news and bookmark reliable online news outlets. 9. Set aside funds. Assess and commit to the amount of capital you're willing to risk on each trade. Many successful day traders risk less than 1% to 2% of their accounts per trade. If you have a $40,000 trading account and are willing to risk 0.5% of your capital on each trade, your maximum loss per trade is $200. 0.5% x $40,000. 8. Set aside time. Day trading requires your time and attention. You'll need to give up most of your day. Don't consider it if you have limited time to spare. Day trading requires a trader to track the markets and spot opportunities that can arise at any time during trading hours. Being aware and moving quickly is key. 7. Start small. As a beginner, focus on a maximum of 1 to 2 stocks during a session. Tracking and finding opportunities is easier with just a few stocks. Recently, it has become increasingly common to trade fractional shares. That lets you specify smaller dollar amounts that you wish to invest. This means that if Amazon shares are trading at $3,400, many brokers will now let you purchase a fractional share for an amount that can be as low as $25 or less than 1% of a full Amazon share. 6. Avoid penny stocks. You're probably looking for deals and low prices, but stay away from penny stocks. These stocks are often illiquid and the chances of hitting the jackpot with them are often bleak. Many stocks trading under $5 a share become delisted from major stock exchanges and are only tradable over the counter, OTC. Unless you see a real opportunity and have done your research, steer clear of these. 5 times those trades. Many orders placed by investors and traders begin to execute as soon as the markets open in the morning, which contributes to price volatility. A seasoned player may be able to recognize patterns at the open and time orders to make profits. For beginners, though, it may be better to read the market without making any moves for the first 15 to 20 minutes. The middle hours are usually less volatile. Then the movement begins to pick up again toward the closing bell. Though rush hours offer opportunities, it's safer for beginners to avoid them at first. 4. Cut losses with limit orders. Decide what type of orders you'll use to enter and exit trades. Will you use market orders or limit orders? A market order is executed at the best price available at the time, with no price guarantee. It's useful when you just want in or out of the market and don't care about getting filled at a specific price. A limit order guarantees the price, but not the execution. Limit orders can help you trade with more precision and confidence because you set the price at which your order should be executed. A limit order can cut your loss on reversals. However, if the market doesn't reach your price, your order won't be filled and you'll maintain your position. More sophisticated and experienced day traders may employ the use of option strategies to hedge their positions as well. 3. Be realistic about profits. A strategy doesn't need to succeed all the time to be profitable. Many successful traders may only make profits on 50% to 60% of their trades. However, they make more on their winners than they lose on their losers. Make sure the financial risk on each trade is limited to a specific percentage of your account and that entry and exit methods are clearly defined. 2. Stay cool. There are times when the stock market tests your nerves. As a day trader, you need to learn to keep greed, hope, and fear at bay. Decisions should be governed by logic and not emotion. 1. Stick to the plan. Successful traders have to move fast, but they don't have to think fast. Why? Because they've developed a trading strategy in advance, along with the discipline to stick to it. It is important to follow your formula closely rather than try to chase profits. Don't let your emotions get the best of you and make you abandon your strategy. Bear in mind a mantra of day traders: plan your trade and trade your plan. Essential skills and tools for day traders: knowledge and education. A solid understanding of financial markets, technical analysis, and trading strategies is essential. Traders should continuously educate themselves through books, courses, and market analysis. Risk management. Day traders must implement effective risk management techniques, such as setting stop-loss orders and managing position sizes. Preserving capital is crucial to survive and thrive in day trading. Discipline and emotional control. Maintaining discipline and emotional control are vital traits for day traders. They must stick to their trading plans, avoid impulsive decisions driven by fear or greed, and learn from both winning and losing trades. Reliable technology. Day traders rely on fast and reliable internet connections, trading platforms, and real-time market data. Access to accurate and up-to-date information is critical for making informed trading decisions. What makes day trading difficult? Day trading takes a lot of practice and know-how, and several factors can make it challenging. First, know that you're going up against professionals whose careers revolve around trading. These people have access to the best technology and connections in the industry. That means they're set up to succeed in the end. If you jump on the bandwagon, it usually means more profits for them. Next, understand that Uncle Sam will want a cut of your profits, no matter how slim. Remember that you'll have to pay taxes on any short-term gains, investments that you hold for 1 year or less, at the marginal rate. An upside is that your losses will offset any gains. Also, as a beginning day trader, you may be prone to emotional and psychological biases that affect your trading. For instance, when your capital is involved and you're losing money on a trade. Experienced, skilled professional traders with deep pockets are usually able to surmount these challenges. Basic day trading techniques. Now that you know some of the ins and outs of day trading, let's review some of the key techniques new day traders can use. When you've mastered these techniques, developed your trading styles, and determined what your end goals are, you can use a series of strategies to help you in your quest for profits. Although some of these techniques were mentioned above, they are worth going into again. Following the trend. Anyone who follows the trend will buy when prices are rising or short sell when they drop. This is done on the assumption that prices that have been rising or falling steadily will continue to do so. Contrarian investing. This strategy assumes a rise in prices will reverse and drop. The contrarian buys during a fall or short sells during a rise, with the express expectation that the trend will change. Scalping. This is a style by which a speculator exploits small price gaps created by the bid-ask spread. This technique normally involves entering and exiting a position quickly, within minutes or even seconds. Trading the news. Investors using this strategy will buy when good news is announced or short sell when there's bad news. This can lead to greater volatility, which can lead to higher profits or losses. Which trading strategy is easiest for a beginner? Following the trend is probably the easiest trading strategy for a beginner, based on the premise that the trend is your friend. Contrarian investing refers to going against the market herd. You short a stock when the market is rising or buy it when the market is falling. This may be a difficult trading tactic for a beginner. Scalping and trading the news require a presence of mind and rapid decision-making that, again, may pose difficulties for a beginner. Why is it difficult to make money consistently from day trading? Making money consistently from day trading requires a combination of many skills and attributes. Knowledge, experience, discipline, mental fortitude, and trading acumen. It's not always easy for beginners to implement basic strategies like cutting losses or letting profits run. What's more, it's difficult to stick to one's trading discipline in the face of challenges, such as market volatility or significant losses. Finally, day trading involves pitting wits with millions of market pros who have access to cutting-edge technology, a wealth of experience and expertise, and very deep pockets. That's no easy task when everyone is trying to exploit inefficiencies in efficient markets. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go.